Hello friends, welcome to learning sessions, and we have already covered one video for the JAIIB, and this is going to be the second video for the accounting and financial management for the bankers, and we are going to discuss about the basic accountancy procedures. In the last video we discussed about the basics of GAAP, we discussed about the transfer pricing, and let me tell you, a very good session and very important one also for the basics of the accountancy. So make sure to watch each and every single live video, because these live videos are going to be free of cost during the live session, and after the live sessions the videos will be available only for the premium members, and the premium members will also enjoy the benefits, like they'll be getting the access to the PDF notes which they can download and they can take a printout of it, and further they will be getting the access to the case study videos, chapter wise previous year questions, mock test, mega test, and further also they will be getting the access on the application as well as on the website. So let's start today's session without giving up away, and if you want to join us, just do WhatsApp writing JAIB updates and WhatsApp it to the number 83609442007. A very good offer is going on right now, LS Pro, where you will be getting extra rupees 500 off on the early bird pack. So do join right now and start your preparations, right? Let's say start the session now. So today's chapter it's related to the basic accountancy procedures. Now, whenever we are doing the bookkeeping, first of all we do need to do what, as I told you in the previous video also. First of all, we are going to enter in the journals, and after the journals we are to post the entries into the ledger, and after the ledger we'll be preparing the trial balance. And once the trial balance is prepared, that's basic balancing both of the sides. Debit side is to be made equal to the credit side, right? And we'll be looking into it. If both the sides are equal, it means our trial balance is matched and we can move further. And after that, we do prepare the final statements. Final accounts, we can say. Final statements means balance sheet I'm talking about, or profit and loss account, income statements, those all are being prepared. Clear? Now, whenever we are recording the transaction or we are reporting the transactions, there are some rules. There are some certain basic rules which are to be followed. We have already covered these concepts beforehand. Yesterday we also covered, but today we are going to cover them with examples so that you can easily understand them, and make sure that you can be finding the questions related to it, right? So we have to learn them in a proper way. So at the recording stage, we do deal with the cost concept. In very short, I can say cost concept means that we have to record the value of the assets at the cost price at which the assets have been acquired. Money measurement concept, only those entries to be recorded which can be in the form of money, which are in the monetary form. Business entity concept means business is different from the owner, right? Because any money which is given away by the owner to the business is a liability on the business. Realization concept, dual aspect concept, historical records concept, these all concepts are available at the recording stage, right? So 1, 2, 3, 4, 5 and 6 concepts. These 6 concepts will be available at the recording stage, and at the reporting stage we are having the going concern concept, matching concept, accounting period concept, conservatism concept, full disclosure concept, materiality concept, and consistency concept, right? So we'll be learning them all one by one. First of all, it's related to the cost concept. See, as I told you, like every asset which is purchased, it is to be recorded in the books of account at its cost price. Let's take the case that you purchased an asset amounting rupees 10,000. Let's take a printer we purchased at rupees 10,000 and its installation cost us rupees 1,000. So total cost at which it is acquired is rupees 11,000. So we are to record this particular asset at rupees 11,000 in our books. Okay, so it is to be recorded at rupees 11,000 in our books and not at the current price. Let's say the current price is rupees 15,000, or it could be rupees 7,000. It could be great. It could be, let's say, higher than the previous one, or it can be lower than the previous one. But we are still to record them at the cost price at which we acquired that particular asset. Keep in mind. Okay, so fixed assets are to be kept at the cost price only, not at the market value. Not at the market value. Every transaction is to be recorded at its cost price, not related to the future value, not related to the present value. So unrealized gains must be ignored, right? If you say that I purchased that particular asset at rupees 30,000 and now it's valuing more, you cannot be doing so. You have to reevaluate everything, right? Either you have to adjust the cost, right, or you are to revaluation them. You can be creating a revaluation reserve for the same, but in a general manner you have to record them at the cost price only. And if any item is carrying no cost, let's say you received it as a freebie, then it should not be in your books. It should not be in your books. Let's move further. It's a money measurement concept. So every and any single entry that is there in your books, that must only be there if it can be measured in the form of money. In terms of money, if it can be measured, only then it should be in your books. Otherwise, it should not be in your books. So all the transactions are to be converted into the common form of the money, right? So even if the goodwill is very much important, you cannot measure it in the form of money. Even if the health of the proprietor is very much important, you cannot be measuring it in the terms of money. So it should not be recorded, right? And also, we do not include inflation or deflation when we are dealing with the asset, right? That is also not to be included. So that's about the money measurement concept. The third important concept, it's a business entity concept. Owner is separate from the business. So if owner is adding up some money into the business, it's a liability for the business, because business is having the liability so as to repay that particular amount back to the owner in future sometime, right? So that's a very simple concept. The capital whatsoever it will be contributed by the business owner will be a liability on the business, because business is what? Business is a artificial person, and it is very much different and 100% different from the owner itself. So whatsoever the money which is withdrawn by the proprietor, that will be considered as a drawing, and profit whatsoever is earned by the firm itself would be a liability on the firm. And if any loss is booked, that will be considered as an asset. You must have looked into the balance sheet, and definitely when we'll be learning it further, you'll be noticing that the capital is on the liability side. Capital is on the liability side. It means what? Capital, whatsoever the amount is contributed by the owner, it's a liability on the business. It's a liability on the business. And when we're talking about the loss, let's say if loss is booked, it's on the asset side. It's astonishing, but because both the entities are separate, so if any loss is booked, it means the business is thinking, now this loss is booked, I'm not to return back this much money to my owner. It's an asset for me, right? Being a company, loss is an asset for me, right? The next concept is a realization concept. Now keep in mind, we are to record only those transactions which have actually realized, and it is to be treated realized only when there is a legal liability so as to receive the money, or so as to pay the money. That's it, right? So you are having the obligation, or you are having the authority so as to receive the money which is legally due. Only when it is due or it is realized, only then you should be recording that particular transaction. No future income is to be considered. Let's say the case that you got an order, and you received an advance for it. You should not be considering it as your income until or unless you have not fulfilled the order. You should not be considered this advance as your income. That will be a liability to you, right? Further, it's related to the dual aspect concept. Very much important. Every single entity or every single transaction which is recorded in the books of account is having a double effect. It's having a dual effect. At least one side will be the debit side and the other one side will be credit side. If it is having more than two aspects, at least one side will be debit and at least one side will be credit. That's the aspect. Let's take the case that the X person started the business with rupees 50,000, right? Started the business with rupees 50,000. Now two accounts will be involved. One, it would be related to the capital account, and the other one, it would be related to the cash account or the bank account, right? Let's take the case that you have purchased an asset or you purchased a machinery. Now, which two accounts will be involved? Purchases account or machinery account? Not purchases account, because it's not a like for selling purposes, but if you are going for a fixed asset, it will be machinery account which will be involved, right? So machinery account will be debited. So if you purchase a machinery account is to be debited and cash account, it is to be credited. Now don't just go for debit and credit. So every single transaction is having the dual aspects involved when we are talking about it. Okay, is that clear now? And the accounting equation is what? Asset is equal to capital plus liability. Total of the assets is equal to capital plus liability. That's the balance sheet equation. Because if we talk about the balance sheet, na, it's having two sides: liability side, asset side. On liability side, on the very top, we are having the capital part, and on the bottom, we are having the liabilities part. So that is why the total of the assets is equal to the capital plus liability. Then after that, the next concept is historical records concept. In accounts, whatsoever has already happened, that is recorded. Only that thing is to be recorded. So let's take the case you purchased an business premises for rupees somewhat, let's say for rupees 5 lakh. You have already paid the amount to the vendor. You have acquired that particular place. Now that thing has already happened. Now you can record that particular transaction. So only historical events are, or historical past happenings are recorded. Okay. So business transactions does, we do record those only transactions only which have already happened on date wise manner. We do record them, chronological manner. We do record them. Further, it is a going concern concept. We assume that the business will be there for indefinite longer duration, because if we are to consider it as that we are going to liquidate the business in the very near future, then we are to revalue everything at the current prices, and it will be a very hassle for the people to do it very frequently. So the concept basically indicates that the business is a going concern concept, that it is going to be there for an indefinite period of time, and we should be recording the transactions accordingly, right? So any of the expense that is incurred, it should be basically be treated as an expense. If any income is there, it should be treated as an asset, right? And as I told you, it is a going concern concept only, that we do think like that we are not going to liquidate the assets, and value we do value the fixed assets at the cost price, not the market price. So the first application is this. And moreover, the current assets are valued at the cost price or the market price, whichever is lower. Whichever is lower. Current assets are those assets which change their form from one form to another within a span of 12 months. Those are the current assets. Like let's say we are having the stock. Stock is what? Stock is current asset. So let's say we purchase the stock at rupees 5 lakh. For rupees 5 lakh we purchase the stock. But the current value is rupees 3 lakh. In that scenario, we'll be recording this current asset at rupees 3 lakh, not rupees 5 lakh. Why? Because the current value is lesser than the cost price value or the booked value. So for the current assets, the value which is to be considered, it is a market value or the cost value, whichever is less. Right? And it is a particular this concept only that we do consider the liability, we do consider the depreciation over the longer duration of the time. Depreciation is what? Depreciation is a non-cash expense. It's a non-cash expense. Let's say the case you purchase an asset for rupees 1 lakh and you know that the useful life is going to be there for 10 years and you're using the SLM straight line method of depreciation. Now you'll be booking rupees 10,000 of the depreciation every single year if there is no residual value, no scrap value. If you're not going to get any single penny in the end of 10 years, you'll be considering rupees 10,000 as a depreciation for each and every year. You'll be booking as a charge toward it. Right? It is this particular concept only, that is a going concern concept, that we do take care of the reserves, that we do have the reserves and provisions, because provisions and reserves are there for the future liability. So if you're not considering that it's a going concern concept, it's a going concern, then you should not be going for any of the reserves or provisions. It is just this going concern concept that we do consider that we must be having some reserves, we must be having some provisions. So if there is in any case, if there is some liability arising in the future, we can be paying it off. And it is a going concern concept only that the deferred revenue expenditures are written off over a number of years. Now, what is deferred revenue expenditure? Now, revenue expenditure is something that is to be paid off in this year only. That was basically a liability for this year only. But the deferred revenue expenditure is that particular expenditure which is revenue in nature, but that is going to last for a longer duration than 1 year. That let's say that we have spent rupees 10 lakh on advertisements. Now the advertisement is going to benefit me for the next few years. Let's say for 3 years, it's going to benefit me. Right? Now I'll be considering it as a deferred revenue expenditure because it is deferred in a way that we are going to consume this revenue expenditure for the next 3 years. Right? So that's why it's a going concern concept only. We are thinking that we are not going to liquidate in the near future and we are going to consume those revenue expenditure in the coming future also. Right? This is for the because of the going concern concept only. Further, it is a matching concept. Matching concept is also very much important. I already gave you an example in the last video also. Let me reiterate that particular example to you very much clearly again. Let's take the case that in the month of January, you paid off the rent for the next 12 months. For the next 12 months, you paid off the rent in advance. Now, as we know, the financial years range from April 1st to the 31st March of the next year. Now, on the 31st March of this particular year, one financial year will end and the next financial year will be starting from the 1st April of this year and will be ending in the 31st March of the next year. Right? That's the case. Now, but I have paid the whole rent of 12 months in advance. Here, the 3 months, January, February, March, those are belonging to this current financial year. And starting from April till December, there are 9 months which are belonging to the next financial year. Right? Now, I should be matching the expenses to the particular financial years only so that I can be having a clear picture related to the profit and loss. So we should be matching the expenses of a particular financial year to that particular financial year only, and also any income or any gain, we should be matching it to the current or we should be matching to the same financial year only. Is that clear? Right? So we should be making adjustments accordingly. Now in this scenario, if we consider the 9-month advance money will be considered as a prepaid expense. Now, prepaid expense is what? The amount which we have spent it before. So it will be considered what? It will be considered as an asset. So prepaid expense is always an asset, right? So in the previous concept, I told you that advance is given. It is to be considered as a, if you receive any advance payment, it is to be considered as an asset or liability. Kindly do answer at the earliest. Make sure to be attentive and do post your answers. Give response related to it. So if you have received any advance payment, it's a liability on you, because right now you have not delivered the particular project. It may be the case that you have to return that particular money back, right? So if you have received any advance, it's a liability on you. But if you have made any advance payment, right, that will be an asset for you. So any advance which is given, it's a liability. Advance not given, advance received I'm talking about. So advance received is a liability, but if you have given an advance, if you have paid an advance payment, that's an asset for you, right? Now let's move further. Accounting period concept. Now, if we are considering that we are a going concern, right, we are going to be there for indefinite period of time. Now we are to match ourselves. We are to have a check on our performance. So if we are going to run for a longer duration, we have to record all the transactions. So we divide each and every period into a particular period, regular intervals we can say, so that we can match the particular incomes and expenses to that particular accounting period, right? Like we do consider financial year from 1st April to the 31st March of the next year. That's an accounting period. Now for that particular accounting period, we'll be considering all the particular incomes and expenses for that particular accounting period, and we can get to know that what is our position, right? Otherwise, if we are not considering any accounting period, we are just going on, we won't be able to match our performance. Even if we are to match our performance to industry, specific industry or specific company over there, so if it is also following the same concept, it would be very much easier to match. Like we simply say that the TCS has made this much profit this year, Infosys has made this much profit this year. Now we can match their performance, that whether TCS is performing well or Infosys is performing well. How come this is possible? Only if accounting period concept is there, because they all are following the same accounting standards. Now when the accounting standards are same, we can simply be looking into the fact that the revenue of Infosys is more than the TCS, right? We can get to know the PE ratio for that particular accounting period over there, right? And definitely we can make a comparison between them, right? So that's the accounting period concept. Now let's have a look at the particular concept that we have learned so far. You can be getting the idea again. So first one, it was related to the business entity concept. Honor is very much separate from the business. Money measurement concept, only those things which can be measured in the form of money should be recorded. Qualitative factors are not to be recorded. Further, cost concept, we are to record at the cost price, purchase price plus any of the expenses that they have made for acquiring that particular asset, not at the current market value. But for the current assets, we have to record at the cost price or the market value, whichever is lower, right? For the dual aspect, every single entity or a transaction is having dual concept, two sides at least. One is debit side, one is credit side, and the balance sheet equation says that the assets are equal to the capital plus liabilities. Further, it's related to the realization concept, that amount that is paid to you in advance is a liability on you. It is not realized. You can be considering it as a revenue only when it is realized, right? Not before that. Historical records concept, that only the historical transactions are to be recorded. You should not be going for the let's say future transactions cannot be recorded, right? You can only be recorded those particular events those have already happened, right? That was a historical concept. Further, going concern concept, that the entry is going to be there for a longer duration. It is not going to liquidate in the near future, because if it is going to be liquidated in the near future, then you are to basically count on the current cost only, not related to the cost prices or the previous cost over there. And we do charge depreciation for that. The deferred revenue expenditures basically set off at the for the longer duration. That's also due to the going concern concept only. Further, it is accounting period concept, that life of a business is divided into shorter terms. We can say artificial time periods are there, so that we can regularly measure the performance of that particular business, right? So that's the case. And further, it's related to matching concept, that we should be matching the particular expenses to the same financial year. We should be matching the particular incomes to the same financial year, so that we can be having a accurate profit loss position of the particular company, right? Now, after that, it's related to the main conventions of accounting. Main conventions of the accounting. The one, it's related to the accounting of full disclosures. It means that the entries, every single entry, should be made in such a manner that if even some information is not clear, that should be clear to the owner or the viewer or the consumer of those particular statements. So even when you do when we enter a simple transaction in the system, now in Finacle over there or CBS over there, we do add a narration toward it. For single transaction, it can be done through the narrations, and for the financial statements, it can be done through the notes to the accounts, right? So we should not be concealing or hiding any of the information from the outsiders, right? That's the case. Secret reserves should not be implemented, should not be maintained, right? That's a very important point, that we are not to maintain any of the secret reserves. And the accounts should be prepared very much honestly, and material information whatsoever is material means which whatsoever makes sense, whatsoever should be disclosed, whatsoever that could matter should be disclosed. Further, it's related to convention of materiality. Now, convention of materiality says what? Now, for every single fixed asset, we are to maintain the depreciation account. We are to depreciate that particular fixed asset. Let's say case that you're having a car, you purchased it for rupees 10 lakh for the company. You have to depreciate the value, because its value will be depreciating over the time, right? So we have to provide depreciation for the same. But now let's say case that I purchased a wall clock, and let's say we purchase a wall clock for rupees 500, and that is going to be there for the next 7 years. Now, should I be providing the depreciation to this rupees 500 for the next 7 years? No. Why? Because it is not that much material. It is not going to matter as such. I can be just be considering it as a stationary expense or some expense or some random expense, but not related to a fixed asset. I won't be booking it under the fixed assets. I won't be charging the depreciation toward it, because it will be making the books unnecessarily voluminous, right? So that is not required at all. So that's the convention of materiality. So all the material information should be recorded, right? Not recorded related to insignificant items should not be recorded. You can be recording them separately, right? But not related that you need to write them particularly in the main books over there. Further, it's related to convention of conservatism, very much important. It's the convention of conservatism. We also say it to be the principle of prudence. This is very much important. Why it is important? Because whenever we are going to record the transactions, whatsoever the gains, future gains are there, those are to be neglected. We are not to take care of the future gains or incomes. We are to ignore those future gains or incomes. But if there is going to be any contingent liability, or let's say future possible loss, that should be recorded, right? So for the future loss, you can be having the provisions, you can be having the contingency reserves, right? So contingency reserves and provisions are basically the Due to what? These all are due to the convention of conservatism only, because it clearly says if there is going to be any future gain, it should not be considered, but if there is going to be any future loss, it should be considered. This is said to be the principle of prudence, right? So that's very much important. Further, it's related to convention of consistency. Now, what is convention of consistency? That whatsoever the accounting standards or accounting principles or accounting guidelines you are to follow or that you selected, you should be following those guidelines for the longer duration. That you should be following for the present also. You should be following it for the future also. And whenever it is to be changed, you should be letting know the impact of the change. That's the convention of the consistency. So different conventions were there. Let's have a look at them. First of all, it's related to convention of full disclosure, that every single transaction narration or transparency is to be maintained. Every material information must be given and should not be concealed. Convention of materiality, that every significant transaction should be recorded, and if it is insignificant, it should not be taken care of as such. Like I have already given an example. Convention of conservatism or principle of prudence, that if there is going to be any future loss or liability, it should be recorded, it should be taken care of, but all the possible incomes and gains should be ignored, right? That's the principle of basic prudence. And further, if we look at the details, as per the convention of full disclosure, no secret reserves should be there and all the material information should be disclosed. And as per the convention of materiality, only what matters should be recorded and materiality must be relative. And further, convention of consistency, that we should be sticking to the methods that we are following, and if there are any changes, we should be able to compare those changes, right? So that's the case. After that, it's related to the double entry system. It's related to the double entry system. Now let me just tell you in detail about the entry, journal entry that we did before. I told you that we do purchase. Let's say case that we have purchased the inventory or materials for rupees 20,000, right? We have purchased the stock material for rupees 20,000. Now what will be the journal entry for this? What two accounts will be involved? First of all, the one, it will be the purchases account, and the other one, it's related to cash account. Now purchases account is actually the nominal account, because purchase is an expense, so it's a nominal account. All the income and expenses are nominal accounts, and cash is an asset. Cash is an asset, so it is a real account. So we'll be learning in detail about the journal entries. I'm just letting you know about these details right now, right? So for the nominal accounts, the golden rule is debit all the expenses and losses, credit all the incomes and gains, right? So purchases is what? Purchases is an expense, so we are to debit the purchases account, right? And for the real account, the golden rule is debit what comes in and credit what goes out. So if you're going to receive the particular asset, you have to debit that account, but if you're paying it off, you're giving it away, you have to credit that particular asset. Now when we purchase something, we give away the cash na, right? So it is going out, so debit what comes in and credit what goes out. So cash account is to be credited, right? So this is how we basically get to know that what account is to be debited, what account is to be credited, right? Now let's come back to the double entry system. There are two kind of system for the record keeping purposes. One, it is a single entry system, and the other one, it is a double entry system. Now the double entry system is a very scientific system. Double entry system is a very much scientific system. You get to know the mistakes if there is any, because when you will be doing the balancing, you'll get to know the mistake, arithmetic mistakes. So the single entry system is very much easy to implement, very much easy to understand, but this is not scientific, this is not reliable, because this creates totally incomplete record. It gives you the incomplete financial picture, right? Because you cannot be tracking the accounts as well, right? But this is better for the small businesses because there is lesser ambiguity in the same. But if we look at the double entry system, this is a very scientific system. You're having the scientific standards, because I told you that every single transaction is having at least two aspects, right? One debit aspect and one credit aspect. It could be the case that the transaction could be having more than two debits or more than one credit, more than one debit or more than one credit, but the transaction is having two aspects, debit aspect and the credit aspect, that is right. So every single debit will be having the credit part also. That is why we do follow this, because this is why, because we do follow the balance sheet equation, that is assets are equal to capital plus the liabilities, right? So the double entry system gives you a complete actual financial view. That is very much important, right? So let's have a look at it. The single entry system is time saving, it is economical, but is not scientific, right? Because some transactions are not recorded toward it, only one aspect of the transaction is recorded. Like you'll either be recording the debit side or you'll be recording the credit side, but not the dual aspect is recorded. And further under the system, see, for the nominal and real accounts are not opened except the cash, right? You should be noticing that under the single entry system, nominal accounts are not opened, real accounts are not opened, just the cash account is open. Under the real accounts, only the cash account is opened, otherwise nominal accounts are not opened. So the accounts which are maintained by way of the single entry system, those are incomplete, those are not systematic, and therefore that system is not reliable. Small businesses can be using it, they can be following it because of the easiness. Otherwise, we have to follow the double entry system because it is very much scientific. Every single entity is having dual aspect, debit side and credit side. Balance sheet equation is being followed. What is balance sheet equation? Assets are equal to capital plus the liability, right? So that is being followed. So every single business must be following the double entry concept. It is very much systematic, it is scientific in nature, and it describes each and every transaction, and all the accounts are open, whether it's a personal account, it's a nominal account, it's a real account, all the accounts are being opened here, right? That's the case. Further, let's have a look at the principles of the double entry system. Every transaction, two parties must be interested. One, it is debit entry, second is credit entry. Like I told you, whatsoever the part you consider, even the if the capital is contributed, even some withdrawal is being done, even if you sell the goods, like if we sell the goods, in that case also two entries will be there. How come? See, if you have sold the goods, so sales account will be involved. And if you have sold the goods, either you will be receiving the cash or bank balance, so cash account will be involved. So two accounts will be minimally be involved, right? And further, both the aspects are recorded in the books of account. Twofold effect is there, so you cannot miss the transaction. Let's say even if one entry is being done wrong or posted wrong, you can get to know by the second entry, by the second leg, right? So the double entry system is a complete record of the business transactions, and it gives you complete picture related to it, and you can check the arithmetic accuracy as I told you. Like we do go for the journals, then ledger, then the trial balance is prepared. Trial balance is nothing but it's like checking the arithmetic accuracy. Like the total of the debits and the total of credits must be all equal, right? So if it is matching, that's the trial balance is being done. Is that clear? So it gives you a clear picture related to profit and loss, because profit and loss can be prepared na, all the accounts will be opened, profit and loss can be prepared, and balance sheet can be prepared at any specific period of time, point of time, right? So this is very much systematic and scientific one, and it prevents the commission of fraud, and if a fraud is committed, it can easily be detected. That is why in CBS it is very much easier to detect the frauds, right? Further, it's related to the revenue recognition and the realization. Now, we are to recognize the revenue when the sale is actually made. Let's say case A promised that I'll be buying product from you. That I'll be buying product from you after 2 months. B cannot record it as sale because it is not realized, right? It will be realized like when actually the product is sold by person B to person A. When the delivery has been made, right? When the payment has been made, then only it can be realized. Let's say when the B completed the delivery and the B is having the right of recovery from person A, then we can say, ha, bhai, it has been realized. You can be recognize the revenue. Till realization, you cannot be saying that it is completed. The sale is completed, and further you cannot, take into account the profits. It cannot be done. Let's take the case from the banking point of view. Person A has taken a loan from the bank and he is paying the quarterly installments. He's paying the quarterly installments. And the installments get due in the month of January and in the month of March and June and for the let's say October, right? In these months, installments get due. Now, in the month of February, the bank can take into account the amount which was to be received in the month of January, but not related to the amount which is to be received in the month of March. Getting it? That is when it is realized, when it is due, only then it can be recognized as revenue, otherwise not. Now there is one important point, that's accrual basis or cash basis. In general, in banking, we do follow accrual basis accounting. But for the non-performing assets, we do follow cash basis accounting, right? For the in general account, we do follow the accrual basis accounting. How come? Let's say case that the interest is accrued, right? And it is payable. It is payable and accrued, but when it is due, you can be considering it as an expense. And even if it is accrued, it is an expense for you because you know that you need to pay that much interest to the customer, right? Let's say if you're having 10 crores of deposit with you, you know that you need to pay this much interest to the customer. You're accruing the interest. Let's say we were paying interest on annual basis. On annual basis, after 6 months, for this 6 months period, for 6 months period, 10 lakh of the interest was to be paid. You need to pay the interest after 1 year, but you know that for this much date, for this much time period, you need to pay 10 lakh of the interest. So that is interest accrued. Accrued interest that is payable, right? And that will be considered as an expense. That will be considered as an expense, right? But in case of NPA, in case of non-performing asset, only that income that will actually be received will be considered as a revenue. But for other loan accounts in general, let's say case a person has taken a loan from you and his installment went due on 31st March. He has not paid the installment yet, but you can still be considering that particular amount in your revenue sheet, right? But if it was an NPA, then only the actual amount that you are going to receive, you'll be considering it as your revenue, otherwise not. So for non-performing asset, it is a cash basis accounting which is being followed, but otherwise the banks do follow the accrual basis accounting, right? So you should be understanding the difference between the receipt of the cash or right to receive the cash. So for accrual concept, there is a distinction related to it. It's not required that you should be actually be receiving the cash. Even if you're having the right to receive the cash, you can still be considering it as your revenue. But for cash basis accounting, it is that you need to actually receive the cash, then only can be considering it as your revenue, otherwise not, right? So that's all which is explained over here. You can learn well from here. So that was all about this second unit for the module A. I hope that you must have understood the concepts related to it. If you want to get the complete PDF related to it, just do download the application right now. You can visit the link here, iibf.info/app, right? It is somewhat here. And you can simply be WhatsApping me to writing JAIIB updates to the number 83609 and I'll be sharing all the details with you. So that will be all. Thank you so much and see you again in the next video. Happy learning.